This past Friday, 2 days ago, the S&P 500, NASDAQ 100, and Dow Jones Industrial Average all made weekly 52-week closing highs. In today's video, I'm going to discuss with you 3 reasons why we expect stocks and bonds to trend higher. We're going to take a look at the index charts. We're going to take a look at the bond market, inflation, and what we're expecting from the Fed over the next few months. My name is Larry Tentarelli. I'm the president and founder of Blue Chip Daily Trend Report.
Welcome to Blue Chip Daily, one of the industry's premier sources for high-level daily technical and trend analysis. Blue Chip Daily is ideal for both investors and traders of all time frames who want to be on the right side of major market moves and trends. We focus on over 750 large cap stocks, all major stock indices, over 70 exchange-traded funds, bonds, oil, gold, and Bitcoin. Sign up now for Blue Chip Daily and you will get access to real-time portfolio alerts, premium Twitter page with intraday alerts and commentary, the chart of the day with best idea, daily video and report, and much more. Claim 30-day trial at www.bluechipdaily.com.
In today's video, I'm going to discuss 3 reasons we expect stocks and bonds to trend higher. Today's video is going to be a follow-up video to one that we first did for our subscribers on November 5th. That was titled 10 Reasons We Expect Stocks and Bonds to Rally. And in that video, I outlined technical reasons why we saw major lows in both the stock market and the bond market. Since then, the S&P 500 is up 236 points. The Dow Jones Industrial Average is up over 2,000 points since that first video. So in today's video, we're going to look at our 3 reasons. Technical breakouts. We believe that the FOMC is at the end of their rate hiking cycle and bond yields are rolling over. A brief note, our technical approach, what we do is we analyze charts and trends. And then we develop a base case. We don't start with an opinion or a prediction and then look for data to try to confirm it. We could always be wrong. Our views are based on the charts and probabilities. These are not guarantees. And we always expect standard pullbacks and volatility along the way. So we'll start with the charts, technical breakout. So the S&P 500 this past Friday, 2 days ago, closed at 45.94. And that was the highest weekly close for the S&P 500 going back to January 2022. So this is a 23-month weekly closing high. The prior high was 45.82. So we've got a weekly breakout in the S&P. And if we look at the trend based on the 10-week and 40-week moving averages, which are equivalent to the 50-day and the 200-day, we can see the trend is up for the 10-week, the trend is up for the 40-week, and they're stacked on top of each other. So this is a bullish weekly technical breakout in the S&P 500. If we go to the NASDAQ 100, it closed 2 days ago, 15,997. That's going to be the highest weekly close since December 2021. So 24 months, rising 10-week, rising 40-week moving average, both stacked on top of each other. So this is a bullish weekly breakout in trend in the NASDAQ 100. If we move to the Dow Jones Industrial Average, 36,245, that's going to be the highest weekly close going back also 24 months, December 2021. 10-week is rising, 40-week is rising, stacked on top of each other. Bullish weekly trend and breakout. Now, charts can always pull back. As I said before, we don't expect straight line moves, but what we focus on, what is the major trend? In the major trend right now, we've got weekly breakouts in the 3 major indices. So if we take a look, S&P 500, NASDAQ 100, and then we're going to take a look at bonds for a second, because here's the next item that we're going to take a look at. Bond yields and the US dollar have basically been driving the market for S&P 500, NASDAQ 100, and Treasury bonds. We'll use TLT as the Treasury bond ETF. So if we take a look at bond yields, starting in the middle of July, they had a sharp breakout higher. If we take a look at the US dollar index, middle of July, sharp breakout higher. If we take a look at the S&P 500, middle of July, sharp breakdown. Middle of July for the NASDAQ 100, sharp breakdown. Middle of July for Treasury bonds, sharp breakdown. So there's been an inverse correlation. Bonds higher, dollar higher. Bond yields and dollar higher, stocks and bonds lower. Now what we've seen since the middle of October, bond yields rolling over, beginning of November, US dollar rolling over. Then what we've seen since late October, November, S&P higher, NASDAQ 100 higher, bonds, Treasury bonds higher. So the view that we're going to go with is that higher bond yields, higher dollar has been a headwind for stocks and bonds. And now that these have rolled over, it's a tailwind pushing stocks and bonds higher. So that leads us to number 2. We believe that the Fed is at the end of their rate hiking cycle. So the Federal Reserve, their inflation target is based on PCE, which is the Personal Consumption Expenditures Index. It's not based on CPI. CPI is what the media likes to quote, but the Fed, their inflation target is based on PCE, Personal Consumption Expenditures. We took this right from the Federal Reserve website. And then if we take a look, we can see from the Federal Reserve Bank of St. Louis, the FOMC focuses on PCE inflation in its quarterly economic projection, and also states its longer run inflation goal in terms of headline PCE. So PCE is the number that we want to take a look at. So the FOMC target is 2% for headline PCE. Headline PCE year over year was reported last week at 3%, but month over month it came in flat, no change whatsoever. The current overnight Fed funds rate is 5.25 to 5.50. The Fed's been on pause since July 26th, and our view is that with inflation data in the 3% range, and it's been trending lower, which I'll show you in just a minute, hikes from 5.25 to 5.50 are not likely with inflation in the 3% range and trending lower. Now, the outlier here would be that there could be a sharp reversal in inflation, which is possible. We don't think that that's likely. So this information is from the Cleveland Federal Reserve. They have a program they call Inflation Nowcasting, which is their real-time forecast. So remember, headline PCE, the target is 2%. So what we see right now, the November forecast, because today is December 3rd. So the November forecast from the Cleveland Fed, CPI 304, core at 4, PCE 286, and then core PCE 346. Now there's a little volatility between November and December forecast, but what we want to dial into is the quarterly annualized percentage change. So what they're showing, their real-time forecast for Q4 2023 headline PCE is 2.45. So keep in mind that the Fed's target is headline PCE at 2.0. Right now, their Cleveland Fed is projecting 2.45, core 281, CPI higher. Now, here's the thing. These numbers can move higher. There can be some variance. I'm not an inflation expert, and I don't proclaim to be. But what I take a look at is I look at what is the trend. So what we see is the trend for PCE year over year, 286, quarterly 245. Last month, it was flat month over month. So the key thing is that the trend itself has been working lower. And if we get readings 286, 3%, but then down to 245, it's not likely that with inflation numbers in the mid twos to the mid threes, core PCE at 281, it's not likely from 5.25 that the Fed hikes more with inflation trending lower. Now, once again, obviously, as I said, inflation could always turn higher. There can be outliers, but what we want to do is we want to look at what the probabilities are. So number 3, bond yields are rolling over. So this is a view of the 3-month, 2 years, 5 years, and then the 10-year U.S. Treasury and the 30. So the media tends to focus and the market tends to focus quite a bit on the 10-year. We can see 10 years broke out from under 350 to almost 5%, 4.99 They topped out here recently and now have moved down to 422. But the key thing is the trend. 10 years broke below the 50-day moving average. They held that 50-day since May. The 20-day has started to roll over. The 20-day has crossed the 50-day to the downside, and now the 50-day is starting to turn lower. So the trend in bond yields has gone from an uptrend now into a rollover downtrend. We can see 3-month rolling over, 2 years rolling over, bearish moving average crosses, 50-day turn down, 5 years bearish crosses, 50-day starting to roll over, 30 years bearish moving average cross, 50-day starting to flatten out before rolling over. So our view right now is that bond yields have moved into a topping phase and have started to roll over into a downtrend. Now, while technical bounces are always possible, we'd want to see any bounces hold over underneath this 50-day, right around 460 or so. But the trend right now for bond yields is lower. The trend right now for inflation is lower. And if we take a look at what the bond market is pricing in, so this is from the CME group, and this is the Fed funds futures from the bond market. So what this shows right now, we're at 525 to 550 for the overnight rate. But the bond market is pricing in it as soon as March of 2024, a 55% chance that there is a rate cut down to 5 to 5.25. So a 25 basis point rate cut. By May, the bond market's pricing in an 82% chance that there's at least one rate cut, and possibly that there's already been 2 rate cuts. So by the middle of May, the bond market, the Fed funds futures market, is pricing an 82% chance that there's at least 1 and possibly 2 rate cuts. But what the trend is here, according to the bond market, is they're pricing in quite a few Fed rate cuts, which would make sense if inflation is trending lower. We don't need Fed funds at 5.25 if inflation starts to get down to that 2% range. Now, once again, this information is fluid. It could change at any time, but this is what is being priced in by the bond market, and it's also what's showing up on these charts. So bond yields have rolled over into an intermediate term downtrend. If we take a look at the 10-year Treasury yield chart, we can see that it topped recently 492 on a weekly close below the 10-week, still holding over the 40-week, 10-week starting to turn down. But if we take a look at TLT, which is the Treasury bond ETF, we can see that there looks like a major capitulation low, and this is something that I discussed in our November 5th video. Major capitulation low, extreme volume downside, extreme volume reversal to the upside. Now we've got over the 20-week moving average. We have a bullish moving average cross on the 10-week starting to turn higher. So we're seeing the inverse on the chart in treasuries. There's a lot of volume coming into the upside. So based on all of that, that brings us to the wrap up. Technical breakouts in the indices. It looks like the Fed is at the end of their hiking cycle, and bond yields have started to roll over. So if you enjoyed the information in the video, you can learn more about what we do at bluechipdaily.com. We have VIP member benefits. We have a 30-day trial that you can find out more about. And I hope that you enjoyed the video. We hope to see you online soon.
Subscribe to the Blue Chip Daily YouTube channel for more technical and trend analysis videos and other content.